Hey, everyone. Thanks for watching here. Before we jump into the show, we got a couple quick questions for you. A little trivia for you. Do you know the answer to this? Question number one, how do I get started investing? YouTube search. Is that the right one? Ask a friend. Ask Siri. Hey, Siri, how do you invest, right? Or all of the above. What do you think? A, B, C, or D? What are you thinking? What say you? I would say the answer is A, all of the above. I think when you start, you got to start somewhere. There's a lot of great information out there on YouTube. You're going to have some friends that have had some positive experience. By the way, you're also going to have some friends that have had some negative experience, and that is important to learn from as well. What do you avoid? What are some pitfalls to avoid? And Siri might be able to put you onto some educational content that can help you learn some things, or podcasts that can help you educate you down that lane. So I think, how do you get started? I think the first and best way to start is just to start and get information and continue to grow. And as you learn and find what you like, move down that path. All right, next question. So what is the best investment strategy for beginners? What's the best investment strategy? Should you, A, put all of your money in crypto? Hey, Dogecoin to the moon, baby, right? Should you do that? Should you invest in the stock market? Remember the video that we saw, or there's a movie that just recently out talking about GameStop stock, right? And all that went on with that, with Robinhood and everything. How about letter B? I went in the other way. Letter B, what you researched the most. That's an interesting one. Or D, real estate. Now, we got a couple particular options, but I believe B is the right answer, because I don't know that there is any wrong option here. I think it's just the idea of what you're spending the most time focused on. You never want to kind of get into it. They'll call it willy-nilly. You want to make sure you jump into something. When you jump into it, you've researched it well. You've thought about it. You're making good decisions. Like anything, you want to, the old philosophy, which stands true today, measure twice, cut once. So important. So when you look at things, if you want to invest in real estate long term, maybe you don't have enough monies to do that. So maybe you need to invest a little bit in crypto, or maybe you want to invest in the stock market. And then as you improve in stocks, maybe you start investing in options. And then as you do that, you build some wealth, and then you buy some real estate and you start to diversify. So I think the key here is what you've researched most. That's the key. All right, let's jump into the next question here. The next one is, how much money do I need to start investing? So if you're going to start investing, how much money should you start with? A lot of times people are in a place where they're saying, gosh, I'd like to invest, I'd like to grow my wealth, but I just don't have enough. So let's look at what is suggested here from thoughts as far as the typical starting amount. Well, we got letter A. Option is $10,000. Hey, don't invest until you wait and get 10 grand. Or option B, $100,000. Option C is any amount. And option D is $50,000. We believe option C, ding, 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 any amount is actually the right answer. Why? Well, because, with the way that some of these apps work today, you can buy fractional shares. You don't have to even buy full shares. I mean, literally, you're in a place with a fractional share app that you can invest in and invest in fractional shares, even though you may want to buy into Apple as an example that might be 180, 190, whatever it is, dollars a share based on the time you look at it. Well, if you can buy fractional shares, you don't need $180 to $190 to buy one share. So you want to start with something. I think the biggest thing there is we got to start somewhere, even if it's very, very small. Remember this, you don't have to be great to start, but you got to start to be great. So important. Hey, listen, thanks so much for taking a few minutes to enjoy and hopefully check in on this trivia piece of the pie. Stay tuned to the show coming up here in just a minute called the Invest Well Show. We're going to be talking about, are we falling off or getting ready as a country with stock markets to fall off a financial cliff? Very important. You need to know the answer to that question. We're going to talk about it and give a little history lesson as well of what you can be looking out for coming up soon here on the Invest Well Show. Stay tuned. Welcome into the Invest Well Show. I'm your host, Michael Wall. We're going to talk today about an important question. And that question is, are we falling off or getting ready to fall off a financial cliff? Listen, this is something that I think a lot of people are worried about right now. Whether you have a lot of wealth, a little bit of wealth, you're just starting out, or you're middle of the road, you're in a place where you're saying, what is going to happen to the monies that I have as time moves along, right? And so one of the questions that we have to ask as we look at these things is, what happened in the past? Unfortunately, we have such a short memory in our world today, in our society. We have soundbite memory. We're in a place where we're looking at our cell phone, and we are in a place where we forget what happened yesterday and just looking at tomorrow. Why? Well, we're bombarded by so much media and so many different things pinging us on a regular basis that it can be challenging to know what are some of the key factors we need to be thinking about. So on this show today, I'm going to take a minute and talk about just those things. Listen, when we take a look at the VIX volatility index, right now we know that it's back up to a 2-month high. And what is the VIX, by the way? The volatility index is something that rates volatility. It's not the old Vicks vapor rub that when you were sick when you were younger, remember your parents would say, hey, honey, let's put some of this stuff on your chest or under your nose or whatever to help you feel better and breathe better. No. This is an indicator of fear in the overall markets. Now, there's a lot of reasons why fear can exist. And obviously, we talked previous shows about the Fed and their lack of interest at this stage in the game to lower rates. It sounds like they're going to be keeping rates the same for a little while now. And also, we take a look at the global instability. This has been a constant theme in conversation. But I want to take a history lesson back to look at some things that you may have forgotten. And I believe if you take a minute to evaluate these things, it's an important reminder and can give us some guideposts as to what we can be thinking about around our investments. All right, JP, I've asked, he's our producer, pull up on the screen. There's a chart here. We used Yahoo Finance actually to illustrate this, and I want to take a minute and talk about this. When you take a look at the chart, what we have here are two red lines. I want to focus first on the red line on the bottom. Now, when we look at the red line on the bottom, what you're going to see here is on the very bottom of the screen, you see the numbers like 2003, 04, 05, 06, 07. That's the years, right? Very simply put. And then the blue line is the S&P 500. This is the chart that we're looking at right now. By the way, why do we use the S&P in a lot of ways? Because the S&P is it consists of 500 different companies, whereas the Dow Jones, really is only an indicator of 30 companies. So as a quick example, if we're going to take a look at how are the overall markets doing as a whole, it gives us a better example if we're going to looking at more companies in general. So let's take a look at the S&P 500 and go back all the way to the first peak, which is where the first red line starts, which is in the year 2000. Now, this is so important when we take a look at that chart. 2000 all the way to 2010. If we actually drag the line and we go to 2010, you may remember, and you'll notice right off the gate here, that 2010 is actually lower than where the markets were in 2000. This is so important. If you're over the age of 40 or even over the age of 50, you for sure remember the idea that a lot of folks in those years called that 10-year period the lost decade. Why did they call it the lost decade? They called it the lost decade because if you were just participating in we'll call it the set it and forget it approach. I call it the Ron Popeil approach. Remember Ron Popeil years ago selling his toaster ovens? He says, all you need to do is just set it and forget it. Put your turkey in there, chicken in there, you're good to go. Well, when you look at markets, a lot of times, a lot of investors, they're receiving philosophy from advisors throughout the country. And the philosophy, for the most part, is set it and forget it. In other words, hang in there. It's going to come back. Just stay the course. Don't get out. That's sentiment in a lot of ways. Well, those of you that were invested from the 2000 to 2010 years that were just in markets and they weren't adding new monies in, right? You weren't kind of continually adding new monies via dollar cost averaging. That philosophy caused you in that 10-year period of time to actually not make a lot of money over those 10 years. In fact, some of you didn't make any money at all. That's why they call it the lost decade. All right. Now, if you take a look at where markets are today, that's the second red line, a little bit higher on that chart. You go to the second chart that's a little bit higher. That shows you the last peak that we had and basically around December of 2021. And then over to the right where the blue dot is, that's where we are now. So we're really in no man's land in a lot of ways. I think it's so important, though, to finish this history lesson up, to talk about the reality. And by the way, if you're listening to this via podcast, all you got to do is go to investwellshow.com and you can find out where you can watch this visually. So again, if you're tuning in via podcast and you're on the road and you're like, what chart is Mike talking about? Do me a favor and head over to investwellshow.com. You'll be able to find places where you can actually watch the show live, whether it be Rumble or YouTube or whatever it may be. All right, back to the chart. So when we take a look at this chart here, one of the things that we see is from the years 2012 or 13, okay, if you can run that cursor there, JP, from 2012, 13, all the way up to about 2019 and so on, we see consistent growth in the overall markets. Now, the question we have to ask is, why did that growth happen? Well, one of the main reasons that growth happened was, you may forget this, but quantitative easing. That's the Fed printing money, buying treasuries, and essentially funneling and fueling monies into the overall economy. Now, I don't want to go back and give major history lessons because I've done this in shows in times past, but I think it's important to note a lot of questions. A big question we have to ask is, was this growth really fundamental, strong, solid growth, basically reflecting the overall economy, or was this because there was monies pumped and pushed into the system? Now, when you take a look at basically 16 and on, we see that growth continues to go up in a lot of ways. That's where they call the Trump bump, where people got excited about the overall economy. We had a strong economy, et cetera. And then we come to where we are today, kind of in no man's land. All right, so we're done with the chart there. I wanted to bring that up, though, just for a minute, to history lesson for you. Now, why does that matter as far as where we are today? Well, what we know today is, again, going back to some things we discussed, we got political instability, we got global unrest, we got challenges in our country. We have, I think we all would agree in some elements, a president in our country right now today that is not fully capable of making great decisions or wise decisions or quick decisions, having some mental challenges. And so that creates unrest in the country and instability in the country. We have all of these other factors. So what should you be thinking about as an investor? That's the goal here, is to give you some quick thoughts. I think as an investor, number one, you have to be thinking about the reality that if you've made some monies over the years, that you are in a place where you make sure that you are aware and being familiar with taking profits. I think you also have to think about not looking at just on-market investments as solutions in ways where you are looking to diversify conservatively. If your focus is totally on the market only, as I've talked before in previous shows, you're missing out on opportunity. You got to be thinking about other strategy, getting off market. And then the last thing that I will say, I think this is so important. You can't, this is my perspective, look at investments, long-term investments, through the same lens as we did before a long time. Because over lengths of time, what does the markets look like in 5, 10, 15, 20 years? You know, it used to be when somebody says, hey, you need to invest in something for a period of time, that thinking was 10 years or 15 years or 20 years. In other words, it continued to grow. We used to hear people say, when you retire, it's probably okay to take 5% of your portfolio every year. And then Wall Street commentaries basically changed that to 4% and 3% and so on. So I think you really need to be thinking differently and get more proactive with your overall investments, creating a strategy and structure that provides for a lot of off-market opportunity. But I think right now we have to ask ourselves the question, are the markets going to continue to go up this year with all the turmoil, instability that we have? Are they just going to go and continue to break through barriers? My personal sentiment is I don't believe that that's going to be the case. I don't believe that that'll be the case. However, there is still opportunity out there. This is not a doomsday conversation. There's still opportunity. There's still robust markets and robust opportunity that we can invest in off market, whether it be multifamily or storage or data. And when you look at these opportunities, you want to make sure you analyze every single deal. So I wanted to take a minute and talk to you about whether or not markets are getting ready to fall off a cliff, number one. And number two, really being in a situation where we ask ourselves the question, what are we doing to pay attention, not only to what happened historically, so I wanted to refresh you with some of those things that recently happened really in the last 20 years, right? Not that long ago, but then also where are we today? And as I'm shooting this today, it's Tuesday, the 12th, The VIX is up at an all-time high in the last, I say all-time in the last 2 months. It's up at a peak again, which is causing a lot of instability. Markets in Dow right now is down significantly as I'm shooting this. So this is not a knee-jerk reaction. More so, this is a restructuring reaction, a conversation and a challenge and a call to you, the investors, to say, what can I be doing to rethink where my investments are now? Listen, there's a lot of resources. If you head over to investwellshow.com, if you're listening to this via podcast, a lot of previous and past shows, a lot of great things we've talked about. My challenge to you is get yourself informed and educated, not just in a Wall Street type mentality. Think outside the box when you look at everything that you've worked so hard to build. Last but not least, taxes. We're going to talk about that on another show as well, but be aware of what's happening on that front also. Remember, it's not about how much you make. It's about how much you keep. Listen, be blessed. Share this show with someone that needs kind of a history lesson again to wake up and get their maybe head out of the mud, that they don't just say, well, everything's just going to work out perfectly. No, we need to pay attention and be proactive. Be blessed. See you next show.